Welcome back. I used to think finance was just about saving money. Turns out I was way off.
It's really about one thing: valuation. It's about knowing what something is actually worth, right now, today, not some fuzzy number tomorrow. And that is the core skill, right? It's what separates just, casual spending from real strategic capital allocation. So, let's get into it.
All right, so the first tool in my kit, I like to call it the time machine. And trust me, it's absolutely essential, because in the world of finance, that old saying is true. Time is literally money. And here's the fundamental law that powers that time machine. Think about it. $1 in my hand today, I can put that to work, I can invest it, it can earn interest. But $1 that someone promises me a year from now, well, that's just a promise, isn't it? It's that lost opportunity, that potential to earn something that makes $1 today always more valuable than $1 tomorrow.
So this time machine of mine, it can travel in two directions. If I have cash on hand and I want to know what it could be worth down the road, I use compounding. That's moving money forward in time. But honestly, what I do way more often is the opposite. I'm looking at some future promise of cash, like a project's future profits, and I need to figure out its value right now. For that, I use discounting. I'm literally pulling that future money backward through time to see what it's worth today.
Okay, and here's the engine room of our time machine. Now, don't get hung up on the formulas. The concept behind them is actually really simple. These are the nuts and bolts, the practical tools I use to make real decisions. That top formula, future value, well, that tells you what your money is going to be worth in the future. And the bottom one, present value, that's the one I use all the time, it tells you what a future chunk of cash is worth in your hand today. This is how we stop guessing about the future and start calculating it.
So when you boil it all down, all this math, all this theory, it leads me to one single critical question I ask about every potential investment. Is this thing a gold mine that's going to make me money, or is it a money pit that's just going to suck my capital dry?
And the way I get my answer is with this one powerful metric, net present value. We just call it NPV. What I do is I take all the future cash a project is supposed to generate, I use my time machine to pull it all back to what it's worth today, and then I just subtract what it costs to get started. It's that simple. It gives me the total value of the entire investment in today's dollars. And you know what? After all that work, the final decision is incredibly simple. It's a binary choice. If the NPV is positive, that means the project creates value. I invest. If it's negative, it destroys value. I walk away. End of story. There's no emotion here, no gut feelings. It's just the numbers.
Okay, so that's tool number one. Let's move on to the second tool, which I call the risk compass. Because look, knowing a project's potential return, that's only half the story. You have to know how much risk you're taking to get that return. You need a way to navigate.
And this is like the fundamental law of gravity for investors. It's unbreakable. There's no such thing as a free lunch. If anyone ever promises you massive returns with zero risk, you should run. They're either a liar or a fool. Every single reward has a risk attached to it. Period.
So the big question is, how do you actually put a number on that risk? Well, for that, I use something called the Capital Asset Pricing Model, or just CAPM for short. It's a really slick model that tells me the exact return I should be demanding from an investment to make the risk I'm taking worthwhile, especially when you compare it to the risk of the overall market. And this is how it works. This is my risk calculation. You start with what's called the risk-free rate. Think of it as the return you could get on a super safe government bond. Then you add a risk premium on top of that. And that premium is based on the investment's beta, which is just a fancy word for how much it jumps around compared to the rest of the market. If it has a high beta, it's risky, so guess what? I demand a higher return. The number you get at the end is called the cost of equity. It's the bare minimum return an investor like me needs to see. And remember that number, because it's absolutely crucial for our next tool. All right, tool number 3, the financial engine. Think of it like this. Every single company needs fuel to run. That fuel is capital. But here's the thing. How you mix that fuel, that determines how powerful and efficient your engine is.
And basically, you've got two main types of fuel. First, there's debt. This is like cheap, high-octane race fuel. It's great because the interest payments are tax-deductible, which makes it even cheaper. But if you use too much of it, the whole engine can blow up. That's bankruptcy. The other fuel is equity. This is more expensive, but it's stable. You don't have to pay it back. The catch is, your investors, the equity holders, demand a much higher return for taking on that risk.
So when you blend these two fuels together, you get what's called the weighted average cost of capital, or WACC. Just think of it as the engine's overall miles per gallon, its total fuel efficiency. And here's the bottom line. For any project to be considered profitable, it has to earn a return that's higher than the WACC. It is the ultimate hurdle you have to clear.
So, my strategic goal here is crystal clear. It's all about finding that perfect blend, that perfect recipe of debt and equity that gives me the absolute lowest WACC possible. When you do that, you've built the most powerful and efficient financial engine you can.
This graph shows you exactly what I'm talking about. It's a balancing act. See, as you add more of that cheap debt, your WACC, your total cost, goes down, which is great. But there's a tipping point. You add too much debt, and suddenly the risk of bankruptcy starts to spook everybody, both the lenders and the shareholders, and your cost of capital shoots right back up. My entire job is to find that perfect sweet spot, right there at the bottom of that U-shaped curve.
And here's why that matters so much. This is the big payoff. Getting that WACC as low as possible isn't just some boring accounting exercise. Look at this graph. The moment you hit that minimum WACC, you are also, at that exact same point, maximizing the total value of the company. It's incredible. A more efficient engine literally creates a more valuable company. They're two sides of the very same coin. This is how you create strategic value.
Okay, so let's bring this all home. We're going to make the final call. We've built out our toolkit. Now it's time to put it to work and move from just analyzing things to actually taking action.
So, believe it or not, you now have the core language. You can speak this stuff. You know the right questions to ask. NPV tells you, is this project actually profitable? CAPM answers, am I getting paid enough for the risk I'm taking? WACC tells you, what is my real all-in cost of capital? And you know, once you get comfortable with these, you can start using shortcuts, like the PE ratio, just to get a quick read on whether something looks cheap or expensive compared to its peers.
And this is the big transformation. This is the whole point. With these tools, I don't guess anymore. I don't speculate. I don't rely on a gut feeling. I calculate. I'm not just hoping for a good outcome. I'm trying to engineer one based on the data.
That right there is the fundamental shift in your entire mindset. See, anybody can spend money. That's tactical. But when you use these tools, you learn how to allocate capital. And that is strategic. It's about deliberately putting your resources in the exact places where they can create the most possible value.
So now you understand the language. The only question left is, what are you going to do with this language? Subscribe to grow your net worth.